Hello, everybody. My name is Shraddha Ghosh, and I'm the lead instructor for CPA at Pixel. Today, we're going to talk about the financial statement approach to journal entries. Now, what typically this means is we're trying to have a visual of the financial statements, namely the balance sheet and the profit and loss statement or the income statement, before we think of writing any journal entries. So, how does all of this work out? Now, see, at the cornerstone of accounting is the statement of financial position, also termed as the balance sheet. And there's another name for it, which is called the net worth statement. Now, what does balance sheet mean? Typically says that whenever anybody is asked of their net worth, they would have three elements to their net worth. The first talks about the resources that we have. And the balance sheet says, typically, in a tabular format, that the resources that an entity has is always equal to the claims to those resources. In other words, all the good stuff that an enterprise has, maybe cash, bank, land, building, machinery, technically termed as assets, are equal to those claims that arose as a result of owning these resources. Now, these claims can be broken into two kinds. One is the claims that an entity owes to outsiders, and we technically call them liabilities. And the other is the claim that is owed to internal stakeholders, and we technically call them equity. Now, why is that so? Because the cornerstone of modern accounting is that an entity always is separate from the owners. So even if an owner is contributing anything to the business, ultimately, the business has to return that amount or that asset back to the owner. So this brings us to the fundamental accounting equation, which says that all the good things that an enterprise owns, technically termed as assets, is equal to the liabilities and the equity. In other words, we can also say that the resultant or the equity is the difference between the good things that an entity owes and all the external liabilities that it has to pay back to the external stakeholders. So what is left to be paid to the internal stakeholders is actually the difference between the stuff that an enterprise owes and the claims that it has to settle to the outsiders. So if I were to ask you, what is your net worth? How would you start? You would start by mentioning that, let's say you have a bank account. So let's say very commonly, right? We have some bank balances. I may have a car. I may have some investments, right? Investments in the form of, let's say, stocks or, some equity shares or some bonds that I might be owning. I might have some, some jewelry, let's say, piece of land or a house, whatever, land, building, whatever, right? So I say, okay, these are all the good stuff that I own. But in order to own all of this, okay, in order to own all of this, I also need to pay that EMI balance on my land, let's say, or my house, right? The house EMIs that are yet to be paid. Or let's say I have a car and I put it on an installment and I have to pay the installments. So even if I ask you, what's your net worth? We would always start by saying, these are the things that I have. And this is what I need to pay in order to own this. So the net result is your net worth. Okay. So typically, if I look at it, any accounting entry or any business transaction that is there in an enterprise can always be reconstructed using the financial statement approach, which says that equity is equal to your assets minus liability. Now, if I were to use this to draft my journal entries, I would need certain important information. First, an asset is always a debit. So if I construct a balance sheet with a T approach, all the good things that I have is an asset is always a debit. A liability or an equity, on the other hand, a credit. Now we need to know these in order to construct the journal entries. So let's use this in, as a means of writing some of the journal entries. Now, this is something that we've already established, that equity plus liability is your assets, or equity is a difference between assets and liabilities. Now, if this basic accounting equation has to hold true, that means if I were to say the balance sheet always balances, there can be four scenarios for this equation to mathematically hold true. The first two scenarios talks about a change in the opposite sides of the balance sheet, which says that if the asset increases, there has to be a corresponding increase in either the liability or the equity if you want the weighing scale to remain safe. That means if I put assets on one side and if I put equity plus liabilities on the other side, and if I know that these two balances, then at any point of time, an increase in one has to correspondingly lead to an increase in either the equity or the liability. Let's call it scenario one. The opposite is just also true, right? If the assets come down, this has to result in either the equity coming down or the liability coming down for the mathematical equation to hold true, which is the second scenario. Let's talk about the third scenario now, which is what happens if the changes happen on just the one side of the weighing scale, right? So if this is my weighing scale, and if my equity and liabilities remains constant, in order for this equation to hold true, if one asset goes down or goes up, whatever the case may be, it has to result in another asset having the opposite impact, which means if one asset goes down, the other asset has to go up, or if one asset goes up, the other asset has to come down. Because if this does not change, if the left side of the equation does not change, then the change in one asset has to have an opposite change in another asset for the equation to hold true. And the last is also the same concept applied on the other side of the balance sheet. It says that if the asset has to remain constant, if at any point of time my assets have to remain constant, then in that case, change in either the liability has to be offset by the opposite change in the equity and vice versa. That means if one liability goes up, either another liability has to come down or the equity has to come down for this accounting equation to hold true. So if I just look at the balance sheet, let's just take common examples in order to establish this point mathematically, right? So see, let's talk about the first case scenario. The first case scenario is an asset going up. That means one side of the balancing wheel going up. The other side also has to go up in order for the equation to hold true. So let's look at the first example. Let's say a person, let's say X, transferred his or her savings to his business or to her business. What happens? At one go, the bank account goes up. That means an asset is going up. And on the other hand, now, since it's my own business, let's say I start my own business. When I put in money in my business, that means my equity has to go up, right? Now, depending on who is starting this business, if it's an individual as a sole proprietorship, it can be capital. If it's a proper C corp, it can be an equity share capital, right? So whatever you call it, an equity goes up. So what happens? An asset goes up, leading to an increase in equity. The balance sheet tallies. On the contrary, what about the liability? Same thing. Instead of putting in money on my own, I borrow some money from my friends and then I put it into my business. What happens? The asset, again, the bank account goes up, which is to the tune of $20,000. And now I need to pay to outsiders. And hence it's called the liability, right? So let's say I bring in a new item in my balance sheet and I call it loan from friends. This typically means it's an external claim. And in the event the company goes into liquidation, I need to first pay my friends who are external stakeholders before I pay myself the $35,000 that I transferred in my business. So what's happening? At one go, can you see in both the cases, the asset, if I take this, then the asset went up, leading to either an equity going up or a liability going up. And hence, the journal entries always reflect that. Now, see, if we do the same thing Instead of transferring money to my business, if I'm withdrawing from me money from my business, which is in the form of dividends or drawings, depending on what kind of business I'm running, the same thing would happen, but in the opposite direction. In the first case, the equity comes down because I'm distributing dividends to myself, right? So my equity comes down. That means inherently equity is a credit. So if the equity has to come down, we have to debit equity. And since I'm paying myself, the bank is coming down. That means what? The asset goes down, the equity goes down. So this is the scenario where the asset goes down and the equity goes down. By how much? By 25K. Balance sheet tallies. Or let's say I pay off my creditors. Who are the people from whom I have taken goods on credit? That means I took goods and I did not pay them. Now I'm paying them back. So what's happening? The creditors, which have an inherent credit balance, that has to come down. That means the creditors have to be debited now, right? So creditors account goes on the debit. And since I'm paying them off by virtue of paying them from my bank, my asset is coming down. So what's happening? To the tune of $15,000, my asset is coming down and my liability is coming down. So if I again look at the weighing balance, can you see one asset goes down and this liability is pulling down. So both the ends again balances. Now, this was if I'm looking at the change in the opposite direction. If one goes up, the other has to go up. If one goes down, the other has to go down. What if it's a change on the same side? Look at a situation when I bought one asset and I paid another asset to acquire it. In this example, let's say there was a machinery that was bought. So what happened? My machinery account gets debited. Why? Because it's a good stuff. It's a debit balance, right? So if my debit balance goes up, that means I have to further debit it. So my 40K, my machinery account gets debited. But in order to buy that machine, I need to shell out some dollars from my bank. In other words, my bank reduces. So what's happening? One asset goes up, another asset comes down. Again, the weighing scale remaining same, equity and the liability section I'm not changing. One asset goes up, another asset comes down. The balance sheet tallies. Or what if I tell you that I've received some money from my debtors? Same thing. One of my debtors has paid me money. So what's happening? The bank comes in because I've received that money. So $9,500 comes in my bank. And some of the debtors, which was an asset balance for me, paid me. So now I don't have to recover any further money from them. So one asset goes up and the other asset comes down. Again, the balance sheet tallies. The accounting equation holds true. The last scenario is the same changes, but it happens on only one side, not the assets. I'm keeping the asset as constant. However, the changes are going to happen in either the liability or the equity side of my balance sheet. So how does this work? Let's say in order to settle off my creditor, who is typically a person who's got goods from me and there is no written promise to pay me back. Now I'm very skeptical about this creditor and now I want him to give me a written promise. So what he does, he executes a written agreement, a notes payable, and he gives it to me. So what I have is now, see, let's say, this was a creditor. So I was supposed to pay him money and this guy got skeptical of me. And instead of just an oral promise, he needed a written promise from me. So what would happen? Our oral promise goes away from my book. So my creditor gets debited and a written promise is established in my book. So I call it notes payable and that gets credited. So what's happening? One liability is going down, another liability is going up and my balance sheet. Right? One liability going up, another liability going down, equity is not being touched, going up, going down, my balance sheet tallies. Or what if I convert my long-term bonds by converting them into shares? They were convertible bonds and the bondholders wanted them to be converted to shares. What happens? My equity share capital gets increased because now I have more shares which were issued to the public to the tune of $120,000. And my bonds, which had to be payable and it was established in my books as a liability, that comes down, right? So my bonds payable is debited. In other words, my liability goes down and my equity goes up, which is again the same thing. Instead of one, my liability goes down, my bonds coming down, my equity goes up, assets is constant, the balance sheet tallies. So every time you write this, in fact, initially when accounting was being developed, we just wanted to talk about the balance sheet. So every time a new transaction happened, a balance sheet was drawn. But sooner it was realized that it's impossible to keep on reconstructing the balance sheet. We need a method to it. And that's how the P&L and the journal entries concept came into being. So now let's just bring the P&L or the income statement into the picture. So what happens if the income statement says? See, income statement is, so far what was happening? So far, when I established my business, I just had assets, the money that I bought into the business, or the assets that I transferred to my business, the external claims and the internal claims. So typically, this would have been the only stuff that would have been there on the first day when a business starts. But once the amount is invested in the business, the money multiplies and some profits come in. So typically, when that money is multiplying, I get some revenue. So it's typically the top line or the income that the business generates. And then there are some expenses, which typically would mean the amounts that I have to pay out to those people, let's say salaries, rent, and all that, in order to generate that income. So typically, once my business is established, then the difference between the business earnings and the expenses, netted off with the amount that I pulled back from my business, okay, gives or lies in an account for the retained earnings. Now, why do we have this? Because we want to have a visibility of what was the original money that was put into the business. Let's say we call it contributed capital, right? So the money that was originally put into the business is called contributed capital. And then the money that generates through the operation of the business, that is typically termed as earned capital, right? The money that the business generated by virtue of all of that money that was contributed in the business. So if I want to, so all of this we typically reflect in an income statement, which is a yearly statement that we draw just to understand what is the profitability of a particular enterprise. So at one end, the balance sheet gives me the position of my business, which gives me the idea that how much is the risk that is there in my business. P&L statement, the income statement gives me an idea of how profitably I've been able to deploy my funds to generate income for my business. Now, if that is a scenario, now how does that work as far as the journal entries are concerned, right? So if I just bring in the P&L, my equation would change somewhere like this. We have the assets, which are equal to the liabilities, which is external claim, plus the common stock, typically everything that was made when the company got into existence. But then we had this retained earnings and the net income that the business generated, minus all the drawings. All of this results in the balance sheet, okay? So let's just have some idea about the income statement. Now, as opposed to the balance sheet, an income statement is a yearly statement which gets snapped and posted into balance sheet every year. So every year you need to restart your income statement. That's not the case with balance sheet, because balance sheet balances are cumulative balances which are carried. So whereas income statement starts from scratch, balance sheet has a history. That's the reason balance sheet is termed as a point statement. At one point of time, what is my net worth, which may change the exact next day, right? So whatever is left in the income statement, typically the profitability of the company over a year is carried to the equity section of my balance sheet. Because typically if the business generates profit, that increases the claim of the internal stakeholders. Now, if I were to construct my income statement, this is how it's going to look like, right? It has its debit, it has its credits. All the good things that happens in the business, in other words, all the incomes, all the gains that the business earns is coming in the credit side. And all the expenses and all the losses are reflected in the debit side. So all the expenses and losses debits, and all the incomes and gains are the credits. All the debits, and if my expenses are a debit, typically they would bring down the owner's claim, right? It reduces the equity, and all the credits would ultimately increase the equity, right? Now, with this information, let's just try to work out how the accounting equation is going to hold true in case if I bring the income statement into impact. Now, see, if my incomes and gains are is going to increase my profit, that means they are going to increase my equity. And the expenses and losses, if I have more of the expenses in the business, they're ultimately going to pull back or pull down the equity or the owner's claim in the business, right? So in other words, let's just bring our old balance sheet into picture. Now, what does this mean? This means if my business is running a particular expense or if my business incurred a loss, that loss is reflected by pulling down my equity. And if that old balance that we had still going to hold true, a reduction in equity would have to be supported by either the asset going down or the same side, the liability is going up. Otherwise, the balance sheet equation will not hold true. I repeat, if a decrease in equity caused by the expense of the loss has to balance the balance sheet, either an asset also has to come down in order to contradict, in order to bring down the equity, or a liability has to go up. So this is the same side impact. This is the opposite side impact. If I extend the same analogy to the gains, if there is a gain or if there is an income or the revenue that the business generated, this increases my equity. And if my weighing scale has to balance, then either on the opposite side, the asset has to go up, or on the same side, the liability has to come down. Unless and until this happens, the balance sheet equation will not hold. Now, just like we did in the balance sheet case, let's work out some examples on the income side's impact just to show how this entire thing looks like, right? So look at this now. The first scenario, I had an expense. That means my P&L was debited and it ultimately got posted in my equity and the equity was pulled down. Let's say I paid some salaries. So what's happening here? My salaries is a P&L item. It's an expense. An expense in the P&L is always a debit to the tune of $8,000. And in order to pay the salaries, my bank is coming out. See, every time when you get into a mess. Why? So later on, when we are going to talk more about, let's say, prepaids and pre-received and outstandings, this knowledge is going to come very, very handy, guys, okay? So in terms of confusion, talk about the most certain one. So if there's bank involved, always starts bank. So my expense, so what happened? My expense went up. So if my expense went up, that means my retained earnings. So the amount that was lying in my equity came down. And if my equity is coming down, what's going to happen? On the opposite side, an asset is also coming down, right? So my equity comes down, asset comes down, my balance sheet balance. On the contrary, let's say we have a situation where company bought some stationery on credit. So I needed some stationery. I ordered it. I did not pay for it. So what happened essentially is that my stationery expense, which is an expense on the income statement, that amount gets debited because all the expenses are a debit. And I did not pay right now. So I need to pay later. That means there must be some outstandings on account of stationery, which is typically a liability account. That was lying in my balance sheet. So what happened? On one go, the expense was increased. So if your expense is increased, that means my equity comes down. If my equity comes down, then the liability has to go up. Means on the same side, if my asset is a constant, if that's not moving, then if I put the same weight here, if my equity goes down, that means my liability has to go up. Otherwise, the balance sheet will not tally. Now, what if we're talking about the incomes, right? So let's take first case where we have some credit sales. So what's happening? I am selling goods and I'm not collecting the money right away. So if the sale is final, which we're going to read when we are going to talk about the revenue recognition standards, that means I have credited my revenue or sales, whatever you call it. So my P&L credit hit has happened to the tune of 50K, but this guy has not paid me. That means this guy will be paying me in futures. There is a claim, an oral promise to receive money. And that's a good thing, right? So in my balance sheet, I will debit a debtor or an accounts receivable, whatever we call it, right? To the tune of 50K. So what's happening here? There is an income. Because the income is there, if my income increases, the equity goes up. So if my equity goes up, and if this is a weighing scale that always balances, if equity goes up, then the opposite side, the asset also has to go up, which is reflected in the debtors increasing. So when equity goes up, followed by an asset also going up, balance sheet tallies. What about the opposite scenario? What if it's the same case? My asset is remaining constant. I don't want to change my asset, but if there is a change, I want to reflect it only on the left-hand side. So I say, okay, my asset is constant. I'm not going to touch it. What if somebody just waived off my loan, right? Let's say there was something really phenomenally good that I would have earned, and somebody who I owed to the tune of $400,000, that guy just waived, my loan. So what's happening here? I have a one-time windfall gain. What is the gain? It is a gain on account of loan waiver, right? All of us would expect that to happen times and again, right? So we have a gain lying in my P&L credit or my income statement credit. What has happened? Because of the gain, there is an increase in my equity. So what is happening? There is a liability, right? That was a loan that was standing in my books. So that liability is no longer there. That means the loan account gets debited. So what's happening? At one go, my liability, so let's look at this. My liability has come down and my gain has gone up. So what's happening? Let's reconstruct this. So what that essentially means is there was a gain and hence the equity went up. So once the equity went up, it has to be substantiated by another side of the same scale coming down. So liability went down, equity went up. Asset remaining constant, my balance sheet tallies. So you see how one simple statement, balance sheet always balances, can give you every single journal entry. In fact, it can serve as a guide every time you write a journal entry and you get confused. You can always check it by this. Now let's just end this with a very small practical question that we can solve with the help of this basic accounting equation. Of what? The basic accounting equation, somebody asks you, is very simple. It is your equity is the difference between your assets and your liability. We know that, right? So let's look at this MCQ. Which of the following statements is correct regarding the current year change in the company's equity? Okay. A company's year-end comparative statement of financial position, now I know we're talking about the balance sheet, reflects the following changes from the prior year. Cash increased by $40,000. Now we know that cash is an asset. So what's happening? Asset is going up by how much? By 40K. Okay. So I know that my asset has went up by 40K. Total liabilities increased by 32K. So liabilities went up by 32K. So I know my liabilities went up by 32K. And all the other assets decreased by $65,000. So typically it means that one asset is going up, the other asset is coming down. Okay. So net, my asset has come down by $25,000. So they're asking you, what is the net impact on the equity? So if you look at it, if this equation has to hold true, this essentially means that my asset went down, my liability increased. Typically, this also would have decreased my equity. So the net change in my equity was typically addition of these two. So on the whole, if I look at it, my equity would have shrunk by $57,000, which is the D, if this was the situation. So equity is equal to assets minus liability. Hence, any change in equity should also correspond to this equation. So using this simple equation, we establish the fact that because of these changes, there is a net decline in the equity to the tune of $57,000. So to sum up, this is what we did. To sum up, right? Just a fundamental equation, guys. Balance sheet always balances. And this can be used every time you're trying to either reconstruct a journal entry or, so this is a fundamental accounting equation. And if you have this knowledge, you can work out any journal entry that you want to. Thanks so much for watching, guys. If you want more of these videos, you please subscribe to my channel. And one food for thought I want to leave by the end of this discussion. If I look at the balance sheet and if I say that my bank account is a debit, why is it that every time I look at my bank statement and if my salary is there in my bank account, I get a message saying salary credited? I mean, I don't understand. Bank is good thing. Bank should be debited. Then when I receive a message from the bank, why does it say salary credited? So the answer for this you would get in my next video. I hope you would have got it by now, but for those who haven't, check out my next video for knowing the answer. Thanks so much for watching. Please subscribe to my channel. Bye-bye. Have a good day.